Okay, broadcasting now.
All right. Well, welcome. This is the Finance Administration and Procurement Subcommittee meeting for October 13th. It's about 3 o'clock. We have a welcome and roll call. And if Adrian, if you want to take that as our clerk for the meeting or recording secretary, please do so.
Yes. Hayward.
Here.
Oakland. And San Leandro.
Present.
Okay, we have a quorum.
Excellent. And do we have any public comment?
There is no one on the speaker list.
Thank you. All right. And do you have any raised hands in this conversation?
I
don't see any.
I do not see any raised hands at the moment.
All right, great. So we'll move on to item number 3, approval minutes from September 11, 2020. I'll take a motion or any other comments about it.
Yeah, so moved. They were good.
All right, perfect. And I'll second that.
Okay, so okay, that passes.
Aye and aye.
Yeah, aye and aye. I think technically
let me do
a vote, but
Hayward.
yes.
And San Leandro.
Yes.
Yes. Okay, the motion passes.
You want to take it for granted. We'll look at item number 4.
Great. Thank you all for coming today. This is an update on the EBCE fiscal year 2019-2020 financial audit. And so, Adrian, if you could please move to the next slide, we can get started. So the status of the audit is that it's in the home stretch. It's on the final draft stage. There's just some minor accounts receivable testing that is still being completed before full sign off. As you may be aware, we had some pretty significant changes in that process this year. So the Passetti and Brinker team is going through that for testing. No outstanding issues have been reported to staff. We're expected delivery of the final version within this week, and we will be presenting it to the board on the 21st. Now, Brett, I believe this would be a good time for you to do the
I'm sorry, Jason, can you say that again, please?
Yeah, did you want to do the required communication at this time?
Sure, I'll run through those, and Jason and I were just talking about the logistics of some of these communications, and I will do them for the whole board as well when I attend that meeting later this month, the one that Jason just referred to, and I'll have a PowerPoint as well. Just like Jason said, we're in the past the home stretch. We're right about to burst through the ribbon at the finish line. And just waiting for a couple pieces of information, like you said, on AR, which I believe you're chasing down for us, Jason. Thank you very much. Things went very smooth this year. I won't go through all of our items, just go through some of these, and please interrupt me if you have any questions. No change in significant accounting policies were adopted by EBC throughout the year, except for the recognition of the deferred inflow of resources, which we looked at closely. We had a lot of conversations with Mike and Jason on that. If there's any questions on that, through a combination of me, Jason, and Mike, I'm sure we can answer them, unless you guys, I think the board actually adopted and approved that, so you guys might be all tuckered out on that one. But in case you want to talk about that, happy to do so. No alternative treatments of accounting principles were noted in the financial statements that were discussed with management. That means there was nothing else on the edge. It could have gone either way. We didn't propose any adjustments to the financial statements as a result of our audit. That's always very good. We did not identify any significant or unusual transactions or applications of accounting principles where a lack of authoritative guidance exists. So again, nothing on the cusp where management could introduce bias. There were no disagreements with management concerning the scope of our audits, the application of accounting principles, or the basis for management's judgments on any significant matters. And lastly, we did not encounter any difficulties in dealing with management during the performance of our audit. So like I said, I've got a bit longer presentation for the actual board meeting. Would have been duplicative to show it all here today, but I thought I'd run through the highlights. So I can answer any questions on the scope of our audit that anybody may have.
I might just ask you to elaborate maybe a little bit on the rate stabilization fund. I mean, the questions and dialogue around that. I know that we're deferring about $12 million so that we can maybe look at it to compensate for the local spend that we're doing, about $12 million as well. Were there other questions, concerns from your office around that rate stabilization fund?
Our main focus there was making sure that we had an understanding about how East Bay determined that amount. It is provided for in governmental GAAP and to be described as a deferred inflow. So there is a provision for that. So from that perspective, it makes sense. So we had some conversations and got an understanding of how it was determined, so that the board approved that amount for diverting the revenue to the deferred inflow and put our stamp of approval on it.
And Jason, did you have any other comments about that?
We will see it represented in the financial statements when we get to it. So hopefully, you know, if you have specific application questions, we can speak to them at that point. But for now, I think that Brett has summarized it pretty succinctly.
Okay, thank you. And I think Director Mandel has a comment or question.
Yeah, thank you. So I appreciate the succinctness. I know I'm sort of trying to recall some of the past presentations about the audit, and they've been perhaps a little longer than they needed to be to the full board, especially when you have a busy night. I think a shorter presentation, if possible. I know there's certain things you have to say and present to the board, and I get that. So I'm not asking you to cut those things out. But a shorter presentation that doesn't bury the lead and says, look, you know, there were no significant issues. We identified nothing that needed to be changed. We basically are acknowledging the accuracy of, you know, all the financial reporting. That's the most important thing. And so sort of highlighting that and then taking questions is probably would be my suggestion, to the extent that that is allowed.
It is allowed. And I appreciate getting that kind of feedback from the committee, because sometimes I feel like I'm not saying enough. And sometimes I look and I see nods happening. I'm probably saying too much. So I will certainly follow your lead. As long as I'm making the required communications, we're good to go.
Yeah, I mean, if we need to do a deep dive, we could probably do it here, but try to keep it high level for the rest of the board. And I think that's what I'm hearing from Director Mandel.
Yeah, and I would feel very differently if there were, you know, audit findings of, you know, disagreement or things like that. I'd expect us to spend more time on it, but lacking that, yeah.
Okay, we can continue.
One thing I did want to point out, and I'm sorry, Director Hernandez, I should have addressed this when you asked the question, is that we passed the board passed the rate stabilization fund as a budget stabilization fund in name. And I just wanted to add a note that in the audit, it's referred to as a rate stabilization fund, simply because that's the more common parlance in which people who would read the audit would understand it. So it's just changed for clarity's sake, and internally we can still refer to it as a budget stabilization fund.
Should we footnote that somewhere in the report?
I'm not sure if it necessarily needs to be footnoted.
My comment would be that I don't think that's necessary, Director Hernandez. I think the whole point of using a term that is very well understood from an industry perspective is the whole point. And so if you footnote it, it sort of defeats that purpose. You know, for our internal purposes, you know, I think there was a preference to call it a budget stabilization fund. I might actually recommend we refer to it as a rate stabilization fund just for consistency's sake. I do appreciate why why that comment came from, I think it was from this committee before, to say,
Yeah,
hey, we don't want
was me.
to stabilization. And maybe now is a good time to circle up on that. For consistency's sake, I would probably recommend we go ahead and call it rate stabilization fund going forward. It was just given that that was sort of the advice and counsel from both our auditor and our accountant. I want to check.
So, do you mind if I jump in, Ed?
No, please. It's free flow.
Yes, since it's a small group today. So the reason that I felt that way is in part because we have a rate stabilization reserve. And I didn't, already, and we call it the rate stabilization reserve. And so having a rate stabilization fund and a rate stabilization reserve, I think that's more confusing than having something that shows up in the audit as a rate stabilization fund, but we call it what it actually is in a layperson's perspective, which is a budget stabilization fund. So I feel somewhat strongly about this. I acknowledge that it creates a little confusion for Howard and the auditors, but I think it makes it clear for all the rest of us.
And I think as long as we're not using both the rate stabilization reserve and the budget stabilization fund in the same document, then it's not too big of a deal.
I would also just note that I think in terms of our audit and our financial statements, rate stabilization fund and rate stabilization reserve are, at least they're understood from a finance community perspective. So I don't think it needs that clarification, but I do hear your feedback, Director Lindahl. For internal purposes, folks that are not finance folks, that may not be quite as well understood, and I can fully appreciate that. So maybe as we speak to it in an internal dialogue, we can continue to refer to it as a budget stabilization fund so that we don't cause confusion, because I think you're absolutely right. Just in the informational items that we had, with the CAC, with the FAT meeting, there was clearly confusion from board members in the community. So what's the difference here? So we'll make sure to draw that distinction as we're speaking to it in the board setting. And maybe for official financial statement purposes, we'll keep it as a rate stabilization fund, since that's what the finance community at least sort of understands.
So I just want to recognize that Director Kalb has joined the meeting. I also see Nick Chassett joined us as well as Andrea.
Hi, how you doing?
Welcome.
Welcome, Dan.
We're just covering the audit status. No big news other than the details about the rate stabilization fund versus being the budget stabilization fund in our internal discussion, but for public purposes, using the more standard item convention for it. I'm not sure if we want to catch up anything else that we need to cover for our attendees. Are you okay with this, Director Mendel, having that internal discussion? Okay, and externally, we'll have the audit report say the rate stabilization. Internally, we'll have to make sure when our board is reviewing it that it is stated as a rate stabilization, but for internal purposes, we're adopted as the budget stabilization fund. Okay, thank you, Jason. Thank you, team. I guess if you want to move forward, we can.
Great, thank you. So Adrian, if we could please go to the next slide. Thank you. So these are the financial highlights of the audit that are going to discuss our essential financial position. Now, in the draft audit itself, the thing that it's actually called the statement of net position. It represents a balance sheet structure where it has assets, liabilities, and net position. And so these are the highlights that are found in there. The first is that we're ending the year without any financial debt. We have paid off in August of 2019 any outstanding amount that was owed to the Barclays credit facility. And we had paid off the county in the previous fiscal year, in February of 2019. So we're ending this year with zero financial debt. Assets were estimated at about 208 million. 220 million, with 108 in cash, 76 approximately in accrued revenue and receivables. And then also in there is where we're going to see the 12.7, about 12.6, I think it's 12.68 deferred revenues. And so that is being held as an asset. In addition to the assets, we have 11 million in restricted cash. 7 million of that is what we hold in for our reserve account for the Barclays credit facility, and 4 million is held in our lockbox, and that reduces annually by 1 million. We also have 7.8 million in prepaid energy and 4.5 in settlements and deposits with the Cal ISO and NCPA. Our liabilities are around at June 30th was around 58 million, 57.9. 50 of that was in accrued electricity costs. So electricity that we had already had scheduled that was coming in. 4 million in pass-throughs of user taxes and surcharges, 2.6 million in accounts payable, and 800,000 in other current liabilities. So this put the net position of our organization at about 149.8 million, which is the assets minus the liabilities, and also deducted that 12.7 of deferred revenue. The other main sheet of interest in the financial statements is called the changes in net position. It models that of an income statement, and of which it summarizes our annual revenue of around 477.4 million. 475.7 of that was from electricity sales. We generated about 1.4 million in interest from just the cash in the bank, and 300,000 came in through grants. 12.7 of that was deferred, as discussed earlier, which brought our net revenues to 464.7 for the year. Our total expenses were about 396 million, of which 373.5 of that was in the cost of electricity. 21.4 was in general operations and expenses of overhead, and we paid about 700,000 in interest costs. And to be clear, this is not interest costs on outstanding debt. This is interest costs on having the credit facility available to us. So the overall change in net position for the fiscal year was 68.4 million, which can be found as the net revenues minus the total expense. The details on these numbers and the breakdowns are further elaborated in the actual audit itself on pages 9 and 10 of the draft that's been provided. And we'll navigate to that now if anyone has any questions. There are no, I'm not hearing any questions or comments. So
No questions, okay.
That's good for the moment. And that concludes the overall presentation of the audit. There are some details that, if necessary, can be addressed by either myself or Brett, if there are any additional questions not related to the specific finances.
In regards to the forecasted interest, I think, is that a different item? I saw that earlier, the interest.
Yeah, that's a different item, and that's going to be for the current fiscal year.
Okay, I'll wait for that then.
Okay.
Thank you.
So just to wrap up, item number 4 then is, so Brett will be giving a more detailed presentation at the board, and that there will also be the communication of, shoot, I forget what it was called, the required communications that he gave earlier. He will also present that.
Can I just, quick question to the board members here, specifically Director Mundell, given you had commented earlier, let's keep it succinct and, let's detail what we need to detail. just wanted to clarify, is the information that we're providing regarding financial statements and performance from last fiscal year, is that the right level of detail? Pretty short and sweet, I think, but just want to make sure that you feel like that's sufficient in sort of covering, the financial statements. We can obviously spend a lot more time on it, but you also get lost in the numbers pretty quickly. So wanted to get that feedback.
Yeah, so I think I feel like I've seen all these numbers before in the pre-audited form, and we had some deep discussions about, the end of year results. Maybe I'm remembering wrong, but if I'm remembering right, then I think going through them pretty quickly and just saying, look, yes, the audited numbers do match up to what we've presented to you before, then that's sufficient. If I'm forgetting and we're actually seeing, the 2020 numbers for the first time, then, maybe, I would be prepared to take a lot more questions. But I guess, let me put it this way. If we've seen these numbers before, the 2020 numbers before in the unaudited or the form, then I would suggest you say that right up front. Hey, we presented this in the past, you saw it, we talked about it, but here's the final numbers, so that people don't get confused and think this is the first time they're seeing it, and then end up doing a much deeper dive in a repetitive manner.
Yeah, that makes sense. And I will clarify, we've not presented it in this sort of a cleaned up format before. We have certainly presented bits and pieces of this in various times. For example, during our budget setting process, we tried to provide, the numbers obviously at that stage were more preliminary. So they, some things did shift a little bit, but, materially consistent with this. So we have presented that in the budget context where obviously we've gone through the full line of detail. So we can make that reference that, we provided some version of this, but this is definitely, a cleaned up audit, obviously. So it's much more neatly packaged here, and some numbers have been finalized since prior presentations.
Good. Yeah, I think just say that.
Understood. Thank you.
My only other call out is on page 18 of the financials, and maybe want to discuss that further, assuming that we're serving more customers than 2019 and 2020. 2019 we had accounts receivable about 45.5 million, and then 2020 we have 55.6, and then we've more than doubled the uncollectible accounts, and that's on page 18 of the audit. So I just highlighted that. I think there was some mention about reviewing those early on by our auditors and just going through the AR. I just want to make sure we are clear about that. I know we're not collecting per se because of the COVID pandemic, and we've minimized those collections. But I just want to make sure we have a talking point to that, because it's a significant increase, about $7 million year over year, maybe about 15% or so increase year over year from the previous balance. So just want to make sure we have some talking points on that, because it may come up, but something to highlight there. And I'm glad you have it on screen.
And then if I may?
Yes, please.
Yeah, the other thing that I would be prepared to get asked either by the public or some member of the board is, where's the line item for the local development business fund? And I'm not saying that we need to change the report to add that, but if you are prepared to say, oh, well, the local development business fund is as, $7 million, and it cut across cost of electricity, contract services, and staff compensation, and so we didn't call it out separately. I would be prepared to answer that question if I were you.
Okay. Yeah, we will certainly be prepared to answer that, and that was provided in pretty good detail during the budget setting process. So hopefully that's a refresher, but yeah, we'll certainly have that at the ready.
And we feel comfortable speaking about accounts receivable. I'm sorry, Director Mendo, I just want to make sure I cover that.
Yeah, absolutely. Yeah, we can definitely speak to that, and that was a little bit of a refresher on us increasing the uncollectibles percentage for the Q4 timeframe, which was an item that we brought forward to the board a couple of months ago.
So the budget, wasn't it, Howard? I'm sorry to interrupt.
So in the context of our budget, we talked about for the new fiscal year increasing it from 0.5% to 2.5%.
Yes.
And for Q4, we also increased it as sort of a transitionary period, given that we're started to see the material impacts of COVID. So we stepped that up to Jason, remind me, is it 1.5%?
Yeah, it was 1.5. We basically split the difference.
Yeah, and these are just actuals, though. We're talking about forecasts based on COVID. These are not our actuals, audited statements of our uncollectibles or accounts receivable. So just I want to make sure we're clear what kind of information you have.
I would clarify the difference there is this is our allowance for uncollectible accounts. So this is not to say that we've fully written off these amounts at this stage based off of actual collections efforts that we pursued and were not, say, successful on. Obviously, we have suspended our collections policy, which you're aware of. So the allowance is the allowance. It doesn't change. What you actually sort of write off and what you can't sort of collect, that's more subject to change. And so when you say actuals, you know, that's what I want to clarify there.
Do we have an actuals amount of uncollectibles today or for that fiscal year?
We don't, because it's really just aged receivables. So, you know, this is our allowance related to those aged receivables for what we are in this financial period, assuming that we won't be able to collect. You know, because we have a suspended collections policy, we're not actively pursuing any collections. So it's difficult to say, will we be able to actually collect more from that? And you know, there are a lot of implications right now with different sort of finance plans, you know, that we're talking through, given the COVID and recessionary environment that could make that subject to change. But the allowance is really what we're talking about here, as opposed to, you know, realized uncollectibles, if you will.
Yeah,
Maybe
just
go ahead.
Sorry, just to chime in. So yeah, for the accounting and for these financial statements, this is our estimate of what will not be collected. If we are correct in our estimate, all of these will be written off. We haven't done any write-offs yet. And something that sometimes is confusing is the year-over-year increase. So because we haven't written off amounts from the past, other than minor write-offs, that 5.5 million that's in 2020, that's not new 2020. That's the accumulated balance from 2019 to 2020. So it's not that you had a 2.5 times increase in your bad debt. That from the previous period is rolling over. So and we report on the main financial statements on the balance sheet that net number. So just that 50 million. That's all that affected our revenue. We're writing off that 5 million. We're saying it's not going to be collected. It's not revenue. But this is our opportunity here to break out what that is consisting of. And certainly probably we're in such a volatile, and there's so many question marks about the collection. At some point, probably next year, I would imagine we'll do a significant write-off, which would decrease that 5 million, say. But because we've already made an allowance for that, okay, there's not going to be any net income effect unless our estimate was incorrect in either direction. So anyway, that's just something to keep in mind, especially that this is an accumulated number. At this point, that 5.5 million is accumulated since inception, really.
I'll throw in there too, from the auditor perspective, given the economic climate, when I see that number increase that much, that makes me feel good, because I feel like it's less likely that you're overstating your assets, which would be the accounts receivable. Agree with everything else Jason and Mike just said as well.
Well, I would feel better if it was a lower number, of course. So understanding how we peel back that onion and have visibility to the aging would be something I'd like to see, and maybe have ready for deeper discussion, because I mean, see the aging over time. Where is it spread out? And do we need to deploy some assistance in those markets for the collections, or just be able to write them off sooner so it doesn't get ballooned so much? So you're saying it was 2 million, and we added another $3.5 million on top of that this year. And so it's volatile. We can't really tell, what's really going to settle up, but you have a best estimate allowance, as you'd say, for that uncollectible based on the Q4 activity recommended, and also increasing that for the next fiscal year. So I think for my understanding, a better understanding, it's a good thing I'm asking these questions for myself, as anybody else might want to be more informed about the allowance for uncollectibles. And so I think I'd like to have a little more information around that, and so how you got there. So that's what I would like to see, maybe some kind of summary slide of the growth year over year, how it compounded. For me, being okay in finance, not realizing that's 2 million then, and you've aggregated another $3.5 million. So where did that get aggregated to? Or how can we visualize those numbers to have a supportive role, or some way to reduce that and maybe capture more revenue? Because we're, I'm seeing, interest rates down, so then our interest income is going to go down by half. So how do we sort of tackle this uncollectible allowance and maybe collect some of it? Of course, I understand there will be some places we can't, especially in this environment. But how do we sort of look at that? And maybe here staff can say, well, it's not really worth it. You know, this de minimis comments, maybe it's in places it's not worth it, it's trivial. So I think I just want to be better informed on this item, and I'd appreciate the support from staff.
And Director Hernandez, happy to share more information. As a refresher, we presented, I'll have to remind myself of the exact date, but in one of the board meetings, we did provide an overview of our aging to sort of show the trend of that over time. We can, you know, we generally bring an update to that on the treasury report, and we have a treasury report item for the next board meeting. So that, I think that is the place where we've had at least had that conversation in the past. Certainly to go into that, happy to go into that in more detail, either for that item, or we could do it as a separate item altogether. And the other thing I would just note is right now, as it relates to the collections policy, you know, we have, I would just want to highlight, of course, because we have that suspended, we have intentionally not brought forward something to the board to kind of talk about, you know, what will actually happen with aging, what do we want to do on that front in light of that suspension of that collections policy, given, you know, given COVID is in place. Happy to start doing that, but maybe a little bit premature, just given, you know, that might be putting the cart before the horse in terms of determining when we actually want to sort of just, you know, make the collections policy active again.
No, I'm not asking for the policy to be active. I just have a better understanding of it. And if you want to speak to it during the treasury report, that's fine. But we're going to be in this unstable environment for the next year. So I want to get a better sense of if we're going to be so unstable for the next year. So what kind of plan will we start developing over the next year to be compassionate and caring, but also ensure that we can collect some funds where possible to meet those allowances expectations. So hopefully we can hit those goals that you would say. But I'm just sort of trying to make sure that although we might have presented information, this is the information we get presented today. I want to make sure I'm sort of lining up to the numbers from here. So we can do either audit, but if you say it makes more sense in treasury, we can do it then.
Okay, great.
Well, something I always find interesting is putting it in perspective, and this table is sometimes tricky, that if you think about that 5.5 million as being our uncollectible amounts, it's not the uncollectible portion necessarily of that 55 million. It is true, that's the total balance outstanding, but that's the amount of uncollectible on 850 million of sales for the last couple of years. So you kind of, just to put that in perspective of, you still have an amazing collection success rate. And East Bay has put in the preliminary steps to not overstay our revenue, increasing our allowance, our expectation for what's uncollectible, and the whole process you guys will decide. But I always think that's an interesting point to make. This is the uncollectible portion of all of our sales.
That's a good point. Great, I think we'll keep you on for at least another year, Mike.
Yeah, I think on that point, I think the uncollectibles, I think that's a discussion to have probably in the next year, in the new year, 2021.
Well, you won't be here. What the heck? I mean, you're just going to put it all on me? Just kidding.
You picked up on that, huh? No, no, but I think my sort of hope is that as we start to come out of COVID, or at least see the light at the end of the tunnel, because there's vaccines and things that are available and a schedule that we can start to rely on, that would seem like the logical time to start saying, okay, you know, we've got a 1% or 99.3, you know, collection rate, and that 0.7%, we need to figure out what to deal with, how to deal with it now. Do we write it all off? Do we write off some of it? Do we write off a portion of the residential only? I don't know. But that's going to be a difficult conversation to have while we're in the middle of COVID, I think.
Sure.
So March, maybe. And it should come to this committee.
I'm expecting you as raising your hand on the attendee side.
Yeah.
Okay. Understood. Thank you for that feedback.
Thank you. I don't have any other comments. Thank you, Director Mendo. Thank you, staff. And Director Kalb, do you have any comments or concerns around the audit?
No, thank you, though.
Pleasure. Okay. Team, anything else on this item?
No, I don't think so. I think we can go on to this will be slide 4 of the PowerPoint. Adrian, if you can scroll there.
So that concludes our discussion on the audit. Thank you very much. So moving on to the next item, which I believe is item 5, is the acknowledgement of accountant contract renewal. Last year.
Jason, we'll take our leave then. Sorry to interrupt you.
Thank you, Brett. I appreciate it.
Thank you.
Okay. Thanks, everybody.
Thank you.
Have a good one. Be safe.
So last year, we executed a 1-year contract renewal with Maher Accountancy. They've been our accountant for the last several years since inception, and the contract expires on December 31st of this year. We're seeking a 1-year extension that we will be bringing to the board in the November 18th meeting. And so I wanted to, of course, I invited Mike Maher here to discuss with any questions that the committee members may have in regarding to this item. I will also, due to sensitivity issues, I did not include the actual contract in the information packet here, but I can circulate the contract to the board members.
Just to be clear there, I think we intended to certainly bring the contract forward when we bring an actual item for action to the board. I think it's preliminary at this stage. So I don't think there's anything sensitive in there per se. It's preliminary at this stage.
Thank you, Howard. And so if I wanted to open this up to the committee members to see if they had any questions specific for the accountant before we begin pursuing the contract renewal for the November board meeting.
Director Mandel, any comments? Director Kalb, any comments?
No.
Okay.
And if you need me to drop off or something.
Oh, no,
I don't want to cause an awkward situation, of course. I don't think there's anything pressing on that. But
Just to be clear, this item was not meant for long or thorough discussion. I think we just wanted to give a few quick snapshots, updates to the FAP committee as to what we're intending to bring forward in the next couple of months. So obviously happy to take that comments, and it doesn't sound like there are any, but
just for my sake,
pretty quick updates.
Yeah, we don't have any accountants and staff though. Other accountants and staff. I mean, we have Mike.
That is correct. We do not have any CPAs under staff.
And then just to clarify, Mike, are you a solo practitioner or you have a team that assists you with the work here at EBCE?
Yeah, no, we have a team. So, and we actually work with several CCAs, and
Okay.
we've been doing it for many years. So this is kind of our niche market right now. So yeah, that's one of our selling points, I think, is we have staff from data entry, staff accountants, data analysts, senior accountants, and we also have an audit team on staff here who helps review outgoing reports and other high level stuff. So, we're really able to we have many clients, but having that breadth, that hierarchy of people, I think is really beneficial. It's tough to get all in-house, right? Mm-hmm. And the other thing, just to mention, a lot of our background is actually in governmental audits. So we have a lot of experience doing governmental audits, governmental accounting, all the specifics with that. And we do try to bring that mentality into our work. In particular, one thing we're always sensitive to with our government clients is the need for internal controls and reporting. And all too often, not to bash cities and counties, but sometimes the accounting function is not always, it's either too cumbersome or on these small special districts. Sometimes it's tough to get the true internal controls unless you have a large staff, right? The segregation of duties. Mm-hmm. So having that mix of oversight from management at EBCE, from having somebody else keying in the numbers, having that overlap is an extremely strong internal control. And I think it's a beneficial relationship for sure.
Thank you. And one other clarifying question, maybe for Jason or Howard. What's the logic for the 1-year extension versus 2 or what have you?
We've just traditionally gone on 1 year with Maher Accountancy. It seems to be it's good for on our end in that, you know, if Mike's a pretty stand-up guy, but if any kind of, you know, systems start to fail, it protects us in getting a kind of quick transition to a different accountant if we desire. And then for Mike's side, correct me if I'm wrong, Mike, but I think it works for him in that it allows for him to have some oversight over cost control.
Yeah, that's right. So honestly, it's more on my recommendation that we shorten the terms, because although we would love to have the long-term relationship, and we hope to have a long-term relationship, just the nature of billing, we bill a fixed fee, so it's really hard to keep track of. Well, it's hard to forecast all the changes that are going to happen at EBCE over the next couple of years. Already the growth with staff and different programs, maybe one day territory expansions. So that protects us as far as we're getting paid the same amount no matter what. So it's on us to make things more efficient, but at the same time, we don't want to have to go back to the board or go back and redo these contracts anytime there's a change, or get caught holding the bag, so to speak, if there's a delay before there's a rate increase. So that is more to protect us, honestly. So there's other ways you could frame the contract, and maybe that's something we can discuss. We're in the preliminary stages, the length of time or potential triggers for rate increases or whatnot. But that's the main reason. It's hard to tell where you're going to be in 2 years.
Thank you for that clarification. I think Director Mendel has a question.
Yeah, that's fine. The only comment I'd make is that assuming that the contract terms are, there's not major changes to it, if it's not a huge difference in price or, major clause changes or whatnot, I would expect it to come forward on the consent calendar and move through quickly at the EBC meeting, November 18th.
Yeah, I would concur. But thank you very much.
Great. Jason, you want to move on?
Cool. Yeah. Thank you, Mike. Appreciate you speaking on this matter with us. Okay. Next item is the days liquidity on hand metric. Adrian, could you please bring up that slide? These are primarily informational points, just to kind of create a touchstone with the committee on where we're standing on a financial basis. The days liquidity and adjusted days liquidity on hand metrics are one of the primary, if not the primary metric on the financial side that the rating agencies will look at when we come to rating. And also, I believe it's very useful when interacting with counterparties in terms of establishing credit with them, and so that we can get better rates on our long-term or short-term procurement deals. And so this slide that we're looking at here kind of gives a system by which we determine the days liquidity on hand. And it starts with the top line, which is the cash balance. And this will be shown on the treasurer's report that will be presented at this board meeting. There's about 159 million in cash in our accounts. 11 of that is restricted, as I discussed before. That's held for contractual purposes. Let me, sorry, that's a little small. Adrian, can we zoom in? Or I can bring up my version.
And that's why we wear glasses nowadays in these meetings, just
Yeah,
to be
I
able to see
even have
this.
glasses on.
I bring up my PDF, so I see that in my PDF that I brought up.
So essentially 159 million minus 11 is 148 million. So we have 148, thank you, Adrian, I appreciate it. So we have about 148 million of unrestricted cash. We have Also a 60 million access through the Barclays cash facility, which if we add those together, gives us 208 million. The operating budget that the board passed in June is for 378 million, which works out to just a little over $1 million a day. And so for the day's liquidity, if we just take the unrestricted cash, the 148 million, and divide that by the cost per day, we get to around 143 days liquidity. So that means we have enough cash on hand that we could operate 143 days on average without having to go into the cash facility. If we dip into the cash facility, that buys us an extra, it looks like 58 days to bring us up to 201. And that's known as the adjusted days liquidity. So it's adjusted because it includes the cash facility. Now, the target, the general rough target is 150 for Moody's. Other rating agencies have like slightly other different adjustments, but it basically comes down to a similar position, and that they just want to be sure that we have sufficient operating cash available on hand to incur any volatility in either prices or other operations. And so as you can see, we're getting very close to we're sufficiently in the ballpark by the rating agency standards. And so I wanted to bring this to awareness to the committee so that they can understand our standing in this area. Now, we're still not going to be pursuing the credit rating I believe, for the rest of this calendar year, simply because there is an additional requirement of 3 full years of audited financial statements. This wraps up pretty much our second. And we're going to be entering into communications with the credit rating agencies to see when we can coordinate the timeline to abide with our third fully audited financial statements released next year. And so hopefully that answers most of the questions, or presents a pretty good scene on this information item. Howard, do you have anything you would like to add to this?
Nope, I think it's best to just open up for questions.
Director Mandel, any comments? I see your hand's still up. Not sure if you want to have a comment.
Yeah, I've been trying to remember to lower it. Sorry. So first of all, this is fantastic. I have been trying to do this math in my head periodically. And so thank you for just laying it out nice and simple there. This is really helpful and really appreciated, and very, very clear. So when you said that Moody's wants to see 150 days of liquidity, do they want to see the liquidity on hand, or is it the adjusted liquidity on hand?
Yeah.
Hey, Jason, let me comment on this real quick. So, you know, as much as we'd like to have something really cut and dry and know that, hey, this is our target and this is the exact metric that we use.
Yeah, you see what I'm getting at.
There's a bit more nuance there. You know, first of all, that target, you know, they're not always so clear. 150 is the number and that's all you ever need. And they're also not always clear of, is it 150 days for your adjusted days liquidity on hand or your days liquidity on hand? And one of the really important factors there is whether they actually count your cash facility towards your adjusted days liquidity, because they actually will want to do a full review of your credit facility to understand certain provisions, such as something called a MAC clause, a material adverse condition clause, to determine, hey, do we actually think you're going to have this liquidity under really stressed conditions where you might actually want to draw on the liquidity. So there's definitely some nuance there. That's the reason why we present this here, both numbers, to say, you know, ours is, you know, it's kind of a little bit of a bookend, if you will. And whether, you know, Moody's will evaluate and say, yeah, we'll count that credit facility or we won't, and we don't know if they might give you some type of a discounted sort of credit for that credit facility. So that would actually be discovered through the credit rating process, unfortunately. And so I hesitate to say so definitively, this is exactly what we need and we've hit it.
And I appreciate the nuance there. And I'm not terribly surprised that it's not like a nice, simple number. Since we're getting close to having the level of liquidity that we would want to target, since we're getting close, it might be appropriate for us, and well, do you think it would be appropriate for us to, as an organization, to set a more definitive level, whether that be 150 days or 160 or something more nuanced, at the board policy level, to sort of say, okay, here's the target that we've adopted for ourselves based on what we understand of, the credit rating agencies and what we would need to go out into the market for, to borrow money, through the bonding process. And might we need to hire some bond counsel to help us identify a logical number that we could say, all right, here's our goal. And then use that goal to then make some decisions about our budgeting going forward. If we reach the goal or exceed it, then that makes a big difference with how tight we're going to be when it comes to setting the budget and whether we're willing to spend reserves on different things. And so, we haven't had to worry about this for a couple of years, but it looks like fantastically we're getting close to the point where we get to not worry about it, but get to, take advantage.
Good thing to worry about.
Yeah, exactly.
Yeah.
So what's your thinking on the process there?
I think there's definitely logic to setting a specific target, so we all know kind of what we're operating towards and kind of what cushion or what budget we have then to sort of utilize a little bit more freely, if you will. I will note that the reason to not do that would be because if we go out for a credit evaluation from one of the rating agencies now, we may likely want to go up with another rating agency in another 6 months or another year. My understanding is to actually go and issue a bond, oftentimes they will want you to have 2 credit ratings. And 2 different credit rating firms will likely have slightly different methodology. So we may have different targets, and that methodology, again, is nuanced. So
that's where an expert bond counsel might be able to advise us on a range.
Well, we've had those conversations with our banking partner. We've had that conversation with advisors that we've used actually through the credit facility negotiation process. It's very nuanced. Part of the reason it's nuanced is because credit rating agencies don't exactly want to say this is exactly how we do it. You don't really need us to do it, do you? So there's quite a bit of nuance there that unless you go through the process, you kind of, it's hard to know for sure. And they're subject to change. They've evaluated a few different CCAs, and we've actually seen some of the guidelines and rules change on them. I shouldn't say change on them. The rating agencies themselves, have changed those guidelines.
Well, let me forgive the interruption.
Yeah. The other thing, if I could just throw in one other thing real quick. The other thing is, it's not as if there's okay, you've hit a number and now your investment grade, great, like go spend everything else you'd like to go spend. If you continue to get a better days liquidity on hand, there is an ability to continue to notch up. And so
sure,
where do you notch up meets a certain borrowing rate. And so
I guess let me come at it from the other end, which is that, there are some board members in particular who have really been pushing us to build our reserves. And when we have those conversations, there's a lot of numbers thrown out. Oh, we need 150 days, 180 days, 360 days. We don't really know. And as a group, we haven't really even set a range. And it seems to me like we ought to be able to be a little more precise about it than that sort of chaotic state that we're in now. And so I don't know how we get there, but I guess I'm asking, suggesting, imploring that we figure out what our process is for deciding on a range of a goal, so that we can make budgeting decisions understanding, okay, we're below the range that we want to have, we're above the range we want to have, or whatnot.
Absolutely. And maybe let me let me comment on that. So at least what we've provided to the board through discussion and dialogue is sort of that 150. We've actually seen a range of 120 to 150, which has worked. Obviously, there's a lot of other elements related to a credit evaluation than just a day's liquidity on hand evaluation. And so you might be weaker somewhere else, and they want to see a higher day's liquidity on hand. So it's not a hard and fast rule, but I would say at the range 120 to 150 is actually sort of what we've seen for investment grade rated entities. I think what I'm suggesting is a policy that says this is what it is and it doesn't need to be anything more. That is perhaps something that I would recommend we don't necessarily set. But I think very comfortable in terms of formalizing some of the dialogue and what we're learning through discussion with credit rating agencies and an advisor, so that we kind of understand a softer target. With that said, of course, if you think a hard target is necessary for budgeting purposes and kind of fiscal management, we can do that. There's some risk involved, I guess is what I'm noting. But there's absolutely is a range, in that kind of 120 to 150 days liquidity on hand is a range that we want to be in.
It doesn't have to be a hard target in my mind. A range is fine. And and it can be a little, there'd be some squish to it, I suppose. Mm-hmm. But what we have right now is a bunch of board members who are like, well, we need to build reserves to some big level.
Understood. Okay.
And we can do better than that, right?
Yeah.
And so we can be more precise than big. And I think if it's 120 to 150 days or 120 to 180 or whatever that number is, if we understand what the benefit of potential benefit of going higher is, then we can decide how much we need to be, tight with our budgeting to try and continue to build reserves, or do we just need to basically balance the budget going forward to maintain our reserves, or whatnot. So it's time for us to decide what our reserve policy is, I guess, in my opinion, to target, and it can be a range. Ed, Ed or Dan, you guys, am I being too picky here?
Dan, you want to speak up, or Dr. Kalb?
I'm sorry. I apologize. I stepped away and I only caught half of what you said.
No, I think what Director Mendo's trying to cover is looking to have a solid metric or policy on our daily liquidities on hand, so that we can move towards a credit bond rating for the agency. And so I think what Director Mendo is asking for is sort of, if it sounds like it's something that could be supported in policy, maybe with the rest of the board, because we have some board members who might want to carry a heavy reserve to get that bond rating and to get a better facility and a better, get rid of that lockbox restraint. So I think he's asking for some feedback. Is that about right, Director Mendel?
More or less. I guess I'd just like to set a goal. It could be a range for our reserves, 120 to 150 days, for example, as the goal, or 120 to 180 days as the goal, and have that come to the board for, approval, validation, and then we can measure future budgets based on that range.
One thing that we do have right now is we do have pretty well established reserve policies, which does kind of set goals and targets based on other, like revenue levels or expense levels. And, we are still, we will be coming to you in November as well with, or December with a recommendation to fund the reserves from our net position from this audit. And so there's kind of a feedback there between this day's liquidity and these reserve targets that we have. And if we set one in, I do agree that probably the day's liquidity is more specific, whereas the reserves are more broad because it covers other aspects of functioning. If we set one in terms of, without considering the terms of the other, that could create a policy conflict or targeting conflict. So I just wanted to bring that up, make sure that we were aware of that as well.
It sounds like we can revisit this in December, highlighting the reserves and the value of these days, the liquidity on hand, and how it can help us with the bond rating. I think if we can cover those three items collectively and inform the rest of the board member and ultimately have some kind of direction around maybe policy about helping get towards that goal of that bond rating, to maybe have other opportunities unlock, like that lockbox, then maybe that's where we sort of present it further. Unless you want to see more research done here, Director Mendel, and bring it back as an item in discussion in this committee.
I mean, I think it should come back here at some point with a staff recommendation for a goal or goal range or target range or something, so that we can discuss it, adjust it, approve it, recommend it to the full board, and have the full board discuss it, adjust it, approve it, and then have that guide our budgeting going forward. That's what I'm asking for. And I'm not asking for that today. I don't know.
Understood. And, let us and go back and have some conversations with credit rating, firms and our advisor, and try to get a little bit more direction there. My hesitancy is in part to say, the target is to reach a level that gets us an investment grade credit rating. And that target can be a little bit moving, and I wouldn't want to set a target that is an insufficient target. But to your point, we can set a range. My other
high target, or a high target, or aim high.
Understood.
That we can discuss that.
My other hesitancy is to take it forward as a formal board action item to approve. Puts a very clear standard out there in which we will then be sort of scrutinized from the credit rating agencies themselves. And so to the extent that we want to formalize a policy around that, I'm more hesitant to do. And so having it as more just an informational item of this is the number, and this is what we're hearing from credit rating agencies is I think where I would suggest that we, the sort of the action that we take as opposed to setting a formal policy, because to Jason's point, we have a reserve policy. That's a very formal policy, and that gets scrutinized quite a bit through the credit process.
I would. What I would want from, I thank you, Al, for bringing this up and the staff. What I would want to know is what is the staff's recommendation on the suite of things that we should be doing to enhance our ultimate credit rating and get it as strong as possible, and get the credit rating agencies to see us in a positive fashion. The combination of things that we would want to do, that we might want to consider doing, are a combination of things. I would want to know what the staff's recommendation is in terms of what combination of things should we be doing over what period of time. And the staff is saying to us, okay, doing these 3 or 4 things over these 6 to 12 months is the best set of things we could do that are doable. That's what do you think, board? Should we do it? That's what I want. That's why I want that comprehensive recommendation.
I agree with that. And I'm just sort of envisioning a future conversation where we're presented with an investment opportunity. We can invest, $20 million in a solar array. And then the question that we'll all be having is, do we have enough in reserves to pay for that? I cannot answer that question today. I have no metric with which to answer it. I don't think any of us quite do. And so what I'm asking for is for us to figure out how to answer that question. Do we have enough in reserves to do X? And so
I would say we wouldn't, though, because we would draw down on our days liquidity on hand by pulling from reserves. So which means we need to have higher reserves for those investment opportunities.
Well, I think you would agree, Ed, that if we had 4 years of reserves and somebody wanted to spend, 20 days worth of reserves on something, that the answer would be, yes, we have enough. Right? If we had 2 days of liquidity on hand, then no matter what it is, the answer is no, we don't have enough. But in between 2 million and 400 million, there's a range where we should be comfortable. And it feels like that's a decision we should make before we're presented with specific investment opportunities, so that we're not conflating the two decisions.
Yeah, I mean, we can lean on staff recommendation, but I think at this point, we want to make sure we align our objectives and goals. And maybe this credit rating is one of those, but also to procure our own energy or get into these contracts. And are we able to do so given these sort of limitations and goals? And are they in conflict or not? Being able to see the clear picture that we can move forward with both options, get the better credit rating and invest in this solar array as you presented it. I think that's what we're hearing. And I think I'm supportive of that and bring it back to this committee to further discuss it. Not put us in the position like, oh, now we got to meet this metric and sort of makes it harder for us to operate. So see how we get that right balance.
Understood. Okay. That's good feedback, and we will bring an item back to this committee for further discussion.
Thank you.
Yeah, we won't be meeting again until December, so it might make it a little tight, but we'll see how that final actions for Director Mandel, maybe a meeting there before Christmas and you're off. Thank you. Final item on this agenda.
Okay. On to the final item. Adrian, thank you for that. If we could go back to the slideshow. So the final item is the to update on the bank interest rates that we're seeing in our accounts. When we passed the budget in June, bank rates were around 1.79, 1.8%. And we budgeted for the fiscal year. We took a conservative approach and budget and ratcheted it down to 1.5%. Well, you know, in the plans of mice and men, things go awry, and you know, we've seen a bigger drop than we were anticipated in bank rates. And currently, our bank rate is offering about 0.8%. What this means is that this will represent a slight decline of revenue through the year, somewhere in the order of you know, five to 600,000 less than we were anticipating. So we were estimating around 1.2 million in interest income. If bank rates stay down around where they are through the year, we'll bring in around 700,000. And this update is intentionally because we're in a tight budget year. The budget passed with you know, I think a little over 900,000 in margin, and some of that was attributable to our bank rate estimate. And while there are some you know, there's a lot of moving parts in a budget and in a fiscal year, as you know, this is one where we've seen some movement, and we think it would be worth at least bringing to the attention of the board. It's not a major issue, but it is something to consider in this kind of tight fiscal scenario that we're in. And so I just wanted to bring this to the committee's attention so that one, they could stay apprised on it, and two, if there were any questions or ideas or concerns, that they could be expressed at this time, and you know, staff and public could discuss on them.
Ideas or concerns from the directors? Director Mandel, Director Kalb, Director Mandel.
No, thanks.
Director Kalb.
I'm okay, thank you.
Okay. And so in regards to interest income, we're going to see a loss, or sort of not a gain, of about $500,000 projected from the budget.
Yeah, less than we were anticipating.
And then remind me, if you can, for me or maybe the committee, our investment policy on these kind of interest income. Do we have other vehicles to help us bring a higher interest from our income available to us?
At this time, no, we only have them in interest-bearing accounts at River City Bank.
And do we have any other options available, or something under consideration or staff recommendation?
Howard,
not at this time. I think we want to develop that. I mean, interest rates generally are low right now, so I think, you know, the trend overall, regardless of instrument or vehicle, is going to be down. But you know, we're going to seek other opportunities, you know, for kind of low risk vehicles that still allow us, kind of use of the funds, so, CDs or other things like that, we'll further evaluate that. I think, we first want to make sure we're tracking this information, presenting it, and we don't at this stage have a recommendation yet.
Okay, we'll look forward to recommendations to help us mitigate that loss of $500,000. You know that we have a lot more in sales revenue. Maybe just need to have that much focus, but this year it's razor thin margin on our budget, so that this has a significant impact. Almost, more than half of the net profit of 900,000. I think stated earlier. And here we're losing about 500,000 of it. So this year might be important to focus on this a little bit more than most other years. But I appreciate the attention to this and bringing it to the committee for consideration and any feedback.
Cool.
Excellent, thank you. I think that's your item number 7, and then we have number 8. If we have anything else from staff. I think
that's all the items that I think finance has brought.
Perfect. Yes. Thank you. And then committee comments or questions or items to bring back to the committee. I think that's the next agenda item.
I feel like we covered the future agenda items in the previous topics.
Perfect. Just want to make sure that's noted. Adrian, you have the item that we want to look at. I'm already sort of lost my memory on it, but yes, going back to the days on liquidity and focusing on the planning there of reserves and the metric for the credit rating. I think last time I mentioned interest and update on the Resilient Home Project. What's done run? I think it was in our minutes, but hopefully we can cover that in December. Hopefully it'll be a few more months of metrics with that program, see how well it's doing. Getting solar and storage in the community. It'd be important to see that, and that's all I have. Any other comments, Director Mandel, Director Kalb?
No, thank you.
Okay. I think that was the last item, and then we would adjourn until December 11th.
Okay.
Right. Thank you very much, everybody. Stay well, stay safe. Thank you.
Thank
Great
you.
meeting. I appreciate the support.